This session covers charitable gifts that are not tax deductible for public charities. Now, private charities are different, which we'll be covering separately, but this is for public charities, which most people are more familiar with. So let's go through the situation where you do not get a charitable deduction, even though you're gifting to charities. Objectives: describe the type of gift that is not deductible for income tax. Discuss the importance of advising financial planner to do due diligence. And finally, describe why all charitable gifts are not deductible. Not to be qualified for split interest gifts. Need to be qualified for split interest gifting. Gifts of split interest in real estate is not tax deductible unless it's a qualified charitable remainder unit trust, charitable remainder annuity trust, or qualified personal residence trust. An example, let's say I own an apartment house. I want to leave half of it to my wife when I die, and I want to give the other half to the Boy Scouts of America. Because I split it, it does not qualify as a charitable deduction. Exceptions made if the owner of property is an owner of the split interest and transfers their entire share to the charity. So we'll change the situation. My wife and I in community property own the apartment house, and when I die, rather than giving my half to my wife, I give it to the Boy Scouts of America. It becomes qualified because I gave up all my rights in the split property. Again, you have to be very careful, and general rule is you should be have your client deal with you as well as a tax expert, such as an enrolled agent or a CPA when we're talking about this. And again, a lot of financial planners rely strictly on the charity to help. The problem with that is that, are you doing your fiduciary responsibilities, which in my opinion you're not. You should be independent of the charity. I think most of the charitable lawyers and accountants are very honest. However, let's face it, in any field, there's always going to be some bad apples. And my theory is I'm probably going to get the bad apple from the charities. Directing how a charity should use the gift or benefit is bad. When a donor directs use of the charity or bequest, it is not deductible. So if I get the Red Cross and say I want it to use in the flooding area of southern Mississippi, it takes away the deductibility. If I give it to a charity and I say I want it to be used for the people suffering from the earthquake in Contra County, not deductible. Because these are referred to as earmark gifts, and it's done all the time. But from a technical standpoint, if you do that, you don't get a gift exception. There isn't a gift tax exemption or deduction. An exception is made for support of missionaries, also known as deputized funding, if made under a structured program. So when I think of missionaries, I think of like the Mormon missionaries or the Christian missionaries in Africa. And of course there's missionaries from Ireland and Europe that come to the United States that would qualify. But it's a completely different set of circumstances well beyond the level of this course. As a general rule, again, remember, don't direct the gifts. You can say, I would like it to be considered to go to the people in southern Mississippi or to the people from the earthquake damage in Contra. But when you make it a direction to be used for making a requirement, that's where you lose out. Suggestions are good because the charity will follow 99% of the time. Donations to schools. And this is one that appears quite often. Donations to schools that are really hidden tuition payments that are not deductible. This includes indirect payments that are used to hide the purpose. And again, it might be where you're donating to a private grade school or high school money, or to a church that has a private high school or grade school, and take it as a charitable deduction. You gave them the money to St. John's Lutheran Church, but they had a grade school that your son was going to, or your daughter or granddaughter was going to. That's going to be hidden. So again, it's considered a sham. We look at what the real thing is happening. You have a grandchild or a child at the school of that church. You don't have to add 1 and 1 to get 2. Now, there are situations where you're paying tuition, and in addition to the tuition you're paying, you give money, that is a separate issue, because there again you can show it's not part of the tuition. Contingent gifting. Contingent gifting are not complete and irrevocable, and thus are not deductible. For example, if John starts smoking, his bequest goes to charity. If John ever stops smoking, a gift will be made from the charity, from the trust fund to the charity. I have trouble reading today, don't I? So be quite candid. When you put kind of contingencies in, either contingent precedent or condition subsequent, you do away with the ability to get gifting. Now, do people take that deduction? Sure. But if they get caught, they lose. And let's face it, you have a fiduciary obligation to teach them to do the right thing, and that's not to put the contingencies in. Service and use of personal assets. This is one that I had a lot of problem with in my tax career. Time spent by an individual is never deductible, even if they have a published billable rate. And I've had lawyers even who are giving advice to charities who wanted to take as a deduction because they're billing at $400 an hour. Well, it makes a nice tax deduction, but it's not allowable. Use of personal property is not deductible, such as weekend use of my beach house for the winter of the church lottery, or use of my Boston Whaler boat for a party for the winter. However, out-of-pocket expenses are deductible, including mileage for charitable purposes, and the mileage rate is very nominal. It's probably not worth taking in most cases. And other things such as a Boy Scout uniform and mileage to go camping. If you give the equipment to a charity to use, again, not, but if you give them a title, then you can qualify as under charitable gifting. Gifts to non-qualified charities are not tax deductible. This again is a problem. I've had people tell me, but giving to the homeless people of Compton is, I give it every year, and I've never had it questioned. Well, it's not a qualified charity. Where do you find the qualified charities? The IRS publishes it on the internet. And it's everything but churches, and if it's not listed on that list, it isn't going to be qualified, and you can't take a tax deduction. Churches are not on the list because that's not an issue. They're always deductible. But church-related institutions are not necessarily deductible. They have to be on the IRS list. If they're not on the list, you can't take it as a deduction. And the reason I point out is I would say 70% of the charities you run into, or even more, are not qualified. Yes, there's certain ones you know are qualified, the Boy Scouts of America, the Red Cross, the Heart Fund, but relatively few. And my experience, and it's very limited in that area, but several times I've been involved in checking into charities that are, say, in front of a CVS or a Vons grocery store. The money goes in the pocket of the person who's standing out front collecting the money, or goes to other purposes, not to the purpose they state. And it's the duty of the financial planner to do diligence for the client to make sure they are indeed qualified. And let's face it, even the qualified charities don't give very much in many cases to the actual charitable intent. 90% of it winds up for advertising, administrative cost, and travel, etc. So don't be surprised if you sign something qualified that 10 cents on the dollar is spent on the activities, and on that, out of that 10%, part of that is going to be for some employment of people at a very low level in the charitable chain. Foreign charities, gifts to foreign charities or foreign use is not deductible unless on the list of IRS qualified charities, and very rarely are they. Financial planners should do the due diligence. Now, some of you at this point probably say, hey, I know how people are getting it. Again, we're talking about public charities here, not private foundations. So in public charities, very rarely going to find foreign use. The only one I can think of right now is the Haiti Fund of a few years ago when they had the major earthquake. In summary, in this chapter we learned that charitable tax deduction has limitations, in which financial planner plays a major role in determining the charities that the client should contribute the gifts to that have tax advantages. Again, if the person wants to give the gift to someone that is not tax advantaged, that's fine. But they should realize they cannot take a tax deduction for it. And the client can donate to non-qualified good causes, but realize they can't deduct deduction. I want to repeat that because people don't realize that. I've had financial planners saying, I won't assist you because you can't get a tax deduction. Well, you should assist them. If that's what they want to give to, the welfare for Compton, California, whatever, fine.